Common beginner mistakes for stock market investors. Hey guys, it's Bardi. I hope you are all doing well. In this video, I want to share with you the most common mistakes that individual stock pickers make in their earlier stages. Okay, before everything, I have to say, if you have made even less than 50% of these mistakes, you are a great long-term investor, flat out. Everybody makes almost all of these mistakes when they start investing in the stock market. For example, I myself did almost all of these mistakes when I started investing in the stock market, but I was able to dodge a few by reading about common mistakes that stock market investors do in a forum or somewhere. Back then, there weren't many YouTube videos like this, so I was reading it somewhere. I don't exactly remember where, but thanks to that, I was able to dodge a few mistakes, and I'm hoping that by sharing these mistakes, you can also dodge a few. But before everything, I have to say that I'm not a financial advisor. This is not financial advising, and I'm just sharing my experience and research. Mistake number one: thinking that it is easy. This one is more for those who are just starting to invest in the stock market and they have less than 6 months experience in the market. I remember when I started investing in the stock market, I was seeing these stocks that they were up 1%, 2% every day. And I was thinking to myself, well, if I can get 1 or 2%, let's say 2% on my money every day, I can get about 700% return on my money per year.
Yeah, boy.
I then was compounding it and building my path to Jeff Bezos by the age 30. I even remember I was once identifying my competitors and typing in the Google top 10 richest people in the world. Yeah, I'm not proud of that. I was literally carried away by thinking that it is easy to make money in the stock market. Many people go broke because of this mistake even before they start their journey. I was lucky because of the timing of the market, but not everybody is. Before jumping on the mistake number two, I want to add a quick note here. As an individual stock picker or long-term investor, you don't have to be 100% of the time right. However, it's not like trading that you have to be, I don't know, sometimes 40% of the time right or something like that. As an individual stock picker, you have to be right around 80%, 90%. That's a great number. Anything less than 70%, you're probably doing something wrong. However, I'm talking about a 3 to 5 years period, not 6 to 1 year period. So if you're not that successful, you're probably doing a few of these mistakes in your strategy. So be sure to listen to all of these mistakes. Maybe you can find a few mistakes that you're doing in your investing strategy. Mistake number two. This is a mistake that I see a lot of people do no matter how long they have been investing in the stock market. Listening too much to others. It is a mistake to buy a stock only because somebody else is talking about that stock. If I see somebody else is talking about a stock, I'm going to research about that stock and do my own due diligence. I may also listen what that person has to say, but that's not going to solely influence my decision. We shouldn't be buying a stock based on other people's opinion because we won't be able to make a solid decision when the stock is on a downtrend. I'm not talking about holding a stock. Maybe selling the stock is the right decision, but you don't know what the right decision is because you haven't done your own due diligence. You are just buying the stock because somebody else is talking about it. Remember, listening to others, that's only for getting an idea that a stock just exists. Mistake number three: buying a stock because somebody else is buying. Not somebody else is talking, just somebody else is buying. For example, Warren Buffett is buying something, so you go and buy the same thing. It doesn't matter how much money they have, how successful they are, how much respect do you pay them. You don't have to buy a stock because somebody else is buying. That's a mistake. We have Warren Buffett. The guy is successful and rich. We shouldn't buy the stock because Warren Buffett is buying that. However, I have to say, I really feel more comfortable when I'm buying that stock that somebody successful like Warren Buffett has that stock too. But that's not a reason for me to buy that stock. That's just a plus after buying that stock. I'm happy when I see, oh, I just researched this stock, I like this stock, I bought that stock, and oh, let's see. Warren Buffett also has the same stock. That's a plus for me, not the reason, just a plus. One thing that I want to add here is that I know a lot of people that they have been successfully listening to others and investing in the stock market based on other people's opinion, and they have been just successfully doing it. But I have to say that the market has been on an uptrend for the past almost a decade. Let's see how those people are gonna react on a 2 or 3 year downtrend market if they are just investing based on other people's opinion. And second, what if that person retires or they just stop sharing their moves? What then? You get the point. Mistake number four: getting caught up on short-term fluctuation. For some people, this just never ends because they are deeply drowned into short-term fluctuations or short-term investing. If you're a long-term investor and you have done your own due diligence on a stock and you bought that stock at a decent valuation, and you're planning to just hold that company for upcoming years, maybe 3 years, 5 years, 10 years, it depends. But you don't have to worry about anything in the short term. You're planning to sell that stock maybe after 5 years. So it doesn't matter what the stock price is going to be in 2 or 3 months. So if the stock is high, okay, what are you going to do? If the stock is any lower, you can just buy more shares, so there's nothing to worry about. Stocks are not like cryptos. If the stock price goes too high or too low, they're gonna eventually come back if the fundamentals aren't changing that much. Mistake number 5, getting emotionally tied to a stock. Guys, you're not marrying a stock. This is business. If the fundamentals of the company changes in a way that you don't like the company anymore, or anything in general like that, you can actually sell that stock. You are not married to a stock. You're not their lawyer. You don't have to defend it. You can sell that stock. Don't be a fan of a stock. Mistake number 6, making decisions based on macroeconomics and political risks. Whenever you see everybody is talking about some macroeconomic things like inflation, some politics, know that those bad news are already priced in the stock market. The stock market is about what people expect from the economy in the future, not what the economy is right now or is going to be in the future. So yeah, if everybody is talking about some macroeconomic thing right now, they're already priced in. Making a decision based on macroeconomics and political risks and things like that, this is like predicting the market, which you should never do. Never, never, never try to predict the market. The market is not predictable. Nobody can predict the market, and you shouldn't be doing it so. Mistake number 7, thinking that you're not smart enough. When it comes to investing in the stock market, it doesn't matter what your IQ is, or if you have a degree or something like that, if you are super smart, it just doesn't matter. What matters is your work ethic. How much work are you willing to put doing your own research and doing your own due diligence? In addition to that, one other thing that really matters is your emotions and risk management. Can you control your emotions?
So they're always something to worry about. And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
Mistake number 8, investing too much money too fast. If you have $10,000 right now and you want to invest that money, you don't have to invest that money exactly right now. You can invest that money gradually over a 1 month period or a few weeks period, it depends. But yeah, don't just invest all of your money in one day or in 1 minute. By the way, there is a technique for this mistake that it's worth mentioning, and it's called dollar cost averaging. You can search on Google and see what this technique is. Yeah, if you're gonna gradually invest your money, this is a good technique to research about. If you spend all of your money at once for buying a stock and the next day the stock dips, you're gonna be frustrated because you won't be able to buy that stock when that stock is dipping. So as an individual stock picker and stock market investors, you always want to put yourself on a power side so you can take advantage of those dips. Mistake number 9, revenge investing. This is a mistake that mostly the traders do. However, because beginners are also kind of like traders in the market, so they also do this mistake more often. Revenge investing can be extremely deadly because you're gonna invest in more riskier assets or maybe call options and things like that. That can result on disastrous outcomes. You have to be able to control your emotions in these scenarios. Mistake number 10, buying without researching. Okay guys, I remember when I started investing in the stock market, I had this problem. I think everybody is gonna experience this problem. Even though back then I was watching all these videos or reading a lot about how important it is to do your own due diligence or do your own research, I was still lazy and I wasn't doing my own research. It took me a lot of time to overcome to this problem and get used to doing my own research and due diligence. I think 99% of the new investors don't research enough before buying at least a first company. So what I'm about to say here is that if you want to become a successful individual stock picker and a good long-term investor, you have to do your own research and put the time and the hustle. You can't just invest based on luck. Yeah, maybe it works in the short term, but not in the long term. Everybody can make money in a bull market. That doesn't mean you are doing everything right. So don't be greedy if you have been making money without researching for the past year or two. By researching, you will know when to buy and when to sell. That's very important. Mistake number 11, valuing others' opinion over your own. I talked about how toxic it is to listen to others. It's really funny. There are some investors that they do their own research. They get to a conclusion and they listen to some other guy, for example, a random guy on YouTube, and that guy is saying completely different thing about the company. So the guy that has done all of the research and due diligence, they end up listening to the YouTube guy, and they value other people's opinion over their own. At last, they just end up listening to others, and they have just wasted their time because eventually they are just listening to others and making decisions based on other people's opinion. I never had this problem, so I'm not sure what is the way out of this problem. I just wanted to share with you that this problem exists, so be aware of that. Mistake number 12, overtrading. This mistake is kind of similar to mistake number 4, which was about getting caught up in short-term fluctuations. If you're a long-term investor, you shouldn't be buying and selling stocks every day. You're not a day trader, or even sometimes we can even say every week. You shouldn't be buying and selling stocks every week. One of the reasons that I'm okay with paying commission trades is that it's like a speed bump for overtrading. I used to overtrade when I started investing in the stock market, but now I do maybe 2 or 3 transactions per month. That's it. And I'm an active individual stock picker and in the stock market investor. If you are a beginner and you kind of have this problem, set some rules. For example, tell yourself that you're gonna do maybe only 1 or 2 transactions per week and lower that number in time. Just set some rules for yourself because this is a serious mistake and problem. Mistake number 13, buying penny stocks. Well, what is a penny stock? Here's the definition of penny stock. Penny stocks are those companies that the market cap isn't too large. For example, I think it should be less than 1 billion. Let's say less than 1 billion. It doesn't matter actually that much. But when the market cap isn't too large, the stock price can be extremely volatile. Penny stocks are not for beginners. And I've seen many pumpers and dumpers happening in the penny stock category. In short, based on what I've seen, because many beginner investors listen to others, that's kind of the target for pumpers and dumpers. That's it, guys. Hope you got a lot of value from this video. By the way, be sure to subscribe because I'll be posting more videos like this every week, and I really appreciate it if you hit the thumbs up. Till the next video.